The biggest threat to the US economy was never the AI bubble. It wasn't China, and it wasn't Washington politics. The real risk comes from something far more boring, something you've probably never heard of unless you've gone deep down the finance rabbit hole. That's exactly why nobody's talking about it. If you've been wondering why mortgage rates won't fall, why stocks randomly panic every few months, and why the Fed can talk about rate cuts while financial conditions stay tight, the answer doesn't start in Washington. It starts in Tokyo, in the most boring asset on earth, Japanese government bonds. Japan has quietly been the duct tape holding the global financial system together for 30 years. And that tape is starting to peel. How it started. In 1992, Japan's asset bubble burst. Real estate and stocks collapsed, and Japan entered what became known as the lost decades. 3 decades of no real growth, no inflation, no wage expansion. It was like the economy hit pause and lost the remote. The Bank of Japan did what central banks do when they run out of options: cut rates to zero, then below zero. When that wasn't enough, they introduced yield curve control, essentially capping long-term bond yields by force. The result: Japanese insurers, pension funds, and banks were earning close to 0% on their own government bonds. They had 2 choices: accept zero return or go shopping overseas. They chose the second option. The yen carry trade. Here's how it worked. An investor borrows yen at near zero interest rates, converts it into dollars, and buys US Treasuries yielding 4%. After hedging costs and fees, they pocket the spread. This became known as the yen carry trade. When borrowing is essentially free, money doesn't just flow into treasuries. It flows into tech stocks, real estate, and emerging markets too. At its peak, some banks estimated this trade was worth trillions of dollars, as if the entire global market was running on Japanese liquidity. But the whole system rested on one assumption: that Japanese yields would stay near zero forever. That assumption broke in 2024, when the Bank of Japan ended yield curve control and raised rates for the first time in 17 years, then raised them again. The result: the S&P 500 dropped 6%, and Japan's Nikkei 225 plunged over 12% in a single day, its worst drop since 1987. When Japanese yields rise, 2 things happen: borrowing in yen gets more expensive, and currency hedging gets more expensive too. Suddenly the free money trade isn't free anymore. This marked the start of repatriation, capital flowing back home to Japan after decades abroad. The real issue: the bond market. Japan wasn't just another buyer. It was the largest and most consistent buyer of long-term US Treasuries. And this is where most people are looking in the wrong place. The Fed only controls short-term rates. The 10-year, 20-year, and 30-year yields are driven by supply and demand, not by Jerome Powell. As legendary investor Ray Dalio puts it, the bond market is the backbone of all markets. It sets the risk-free rate that determines returns across every other asset. When supply and demand in the bond market breaks down, long rates rise relative to short rates, currencies weaken, and gold rises. The U.S. runs trillion-dollar deficits every year, meaning the Treasury has to issue massive amounts of new debt just to keep the economy running. Even a small drop in demand matters, and for decades, Japan absorbed a huge share of that demand. What happens if Japan steps back? If one of the largest buyers pulls back, yields have to rise to attract new buyers. This can create a strange situation. The Fed cuts short-term rates, but long-term yields stay elevated. This is called a steepening yield curve. When that happens, it stops being just a bond market story. It becomes an everything story. Stock valuation models discount future cash flows using long-term yields as a baseline. When yields stay high, valuations compress. Even if earnings are fine, the price investors are willing to pay changes. The 10-year Treasury yield isn't just a number on Bloomberg. It's the foundation for nearly every asset price. Mortgage rates are tied to it too. If the 10-year yield doesn't meaningfully fall, mortgage rates won't drift back to 3%, no matter how much the Fed cuts short-term rates. That means housing stays expensive, refinancing stays muted, and home sales slow down. The same logic applies to corporate credit. In 2020 to 21, when money was cheap, companies borrowed aggressively. When borrowing stays expensive, risk appetite falls, growth slows, and capital tightens. The bigger picture. For 30 years, the U.S. benefited massively from being on the receiving end of the world's largest carry trade. Now that trade is unwinding. As Dalio says, the bond market is the backbone of all markets, and what's happening right now could shake that very foundation. This story doesn't get much attention because it isn't flashy. Nobody wants to hear about the cross-currency carry trade. It takes patience and nuance to understand. Instead, people want a simple story. The Fed cuts rates, so everything gets easier. But that's not the full truth. If the world's largest foreign buyer of treasuries steps back, global liquidity tightens, and liquidity is the oxygen of markets. When it dries up, the effects ripple through everything, from stock valuations to mortgage rates to corporate borrowing. The real risks never make noise. They stay hidden in plain sight.